We're joined now by Goodwin. She's an economist and chief market strategist at New York Life Investments to talk about these markets. Loren, are you of the view that investors should be concerned about the possibility that the Fed is going to wait longer than investors had earlier hoped to begin cutting rates?
Good morning, first of all. On a very tactical basis, I think that the market's going to be okay for the next week or so until we see employment data out of the U.S. on Friday and inflation data out of the U.S. next week. That data will serve to substantiate or perhaps put away the concerns that the economy in the U.S. may be overheating. Now, overheating or reaccelerating is, from our perspective, the key risked positioning for the U.S. economy, and frankly for other global economies as well, because it would mean that the interest rate cycle would remain stuck where it is, and we think that that's a more pronounced risk for credit. However, for now, we do anticipate that data will continue to slow over the next few months, and so we're really in a holding pattern tactically until that time.
Can inflation slow the way the Fed would like it to if the employment market continues to be robust?
Now, economic theory would tell you that no, that doesn't make a lot of sense. We would expect to need to see the labor market have more slack, wages move lower in order to feel very confident that inflation would move lower over time. There's one asterisk to that economic viewpoint, which is that new data this month from the Congressional Budget Office in the U.S. has shown us that there's been a big surge in immigration that has historically served to even out the overheating of a labor market, and maybe why we've seen inflation continue to move lower even with a labor market so hot. I think what's challenging for the Fed, and this really is a Greenspan moment for them, is can they trust that productivity and immigration are going to remain the case over the next several quarters? In the middle of a political cycle, I think that's highly uncertain, but we see Chair Powell seemingly willing to take that risk in order to avoid the potentially more challenging credit circumstance on the other side.
Given all of these headwinds, what do you think of the remarkable rally that we saw in equity markets in the first quarter? Are equity valuations stretched at this point?
Well, equity market valuations have reflected some good profit fundamentals and also perhaps the most important market fundamental, which is a Fed that was signaling easing ahead. And so though we've seen, call it nearly 30% of an uptick in the equity market since the lows in October, we think that makes a lot of sense. As we start to look forward, those equity valuations, unless profits reaccelerate, which we're doubtful of, start to become a bit more challenging. So our position in the markets is that we're not necessarily selling equity market strength, but we are using the opportunity to put incremental cash into the market in credit, where of course there's still valuation risk if the economy were to slow, but we see yield as an important cushion for that potential volatility. The other thing that we're considering very strongly in our portfolios is how to build a more structural inflation resilience into a portfolio, because while we do expect inflation to move lower over the next couple of years, as the Fed has signaled, that's still an environment where inflation is higher than it's been in historical periods, and one where we think that a structural position in commodities and other inflation resilient asset classes can make sense.
One of your bits of advice to investors is to diversify away from an overexposure to the so-called Magnificent Seven or the Super Six or the Fabulous Five, whatever we're calling them now, because Apple and Tesla are not really participating these days. Where should investors go if they want to get away, not get away, but reduce their what might be outsized exposure to 5 blockbuster stocks?
Well, we should first acknowledge that the blockbuster stocks have been blockbusters for a reason. They have strong cash, good profit margins. That's essentially a flight to safety in a market that's been very difficult to call for many investors. That said, as you pointed out, exactly what the Magnificent Seven means has shifted over time, and that's because 7 companies just aren't very many, and an idiosyncratic factor impacting any one of them can disrupt your allocation. That said, we think that the reason that these companies companies are seeing stronger demand, fueling the artificial intelligence trend, is here to stay. Just that the future state isn't particularly certain. So we're diversifying Magnificent Seven exposure by adding small and mid-cap growth exposure, those companies that might be the next generation beneficiaries in the application layer of this technology. We're also heavily invested in infrastructure, whether that's infrastructure equity, global listed infrastructure, as well as infrastructure bond, long duration, taxable municipal bonds, typically an asset class that investors outside of the US don't consider as strongly, but this taxable structure we think is really interesting in providing a long duration bond exposure to these artificial intelligence infrastructure themes.
We're almost out of time. Commodities have rallied significantly. Oil, copper, gold, and other commodities are at relative highs. How should investors think about this, and how should they be positioned?
We consider the recent run-up in commodities as a reaction to the reinflationary environment that investors are concerned about. But because we do expect inflation to be more persistent ahead, and because the need for productive materials is likely to be very steady as a result of the electrification and digitization of the economy, we think that a structural allocation to commodities can make sense. Depending on an investor's risk tolerance, we found that math to be about 1 to 7% of an investor's portfolio. So we're talking about a small proportion in the aggregate, but something that is still larger than what traditional portfolio guidance would otherwise have said for a more volatile asset class.